Welcome to the Property Voice Podcast, helping you to navigate safely through the world of property investing. Get the lowdown and updates, insights and outcomes on all matters property with a splash of entertainment along the way. The Property Voice, a voice to trust among the crowd. Now, let's get started with your host, Richard Brown.
Hello and welcome to another edition of the Property Voice podcast. My name is Richard Brown, and as always, it's a pleasure to have you join us today. Now, to some extent, I've been dreading this particular episode. If I mention the word accounting systems and record keeping to you, you might be tempted to switch off at this point in time, and I've been wrestling with the whole concept for at least a couple of days, thinking how to communicate what can be a dry subject and one that maybe lends itself to some alternative presentation, let's say, visually and using numbers, in a written form or with graphics and that type of thing to communicate and articulate in an audio format. So I think I cracked it, actually, and so therefore please stay with me and bear with me throughout the episode. I'm going to do my best to convey what is actually a very important topic as part of property investment. Now, property investing, a lot of people think it's all about property, and obviously property is a significant part of property investing. But there's two other parts, really significant parts of being a successful property investor that we've been aiming to cover over this series, and today covers one of those. And one of them, of course, is people. Now, the last couple of weeks we particularly addressed that with regard to tenants and letting agents and that sort of thing. We've obviously in the past made reference to tradespeople and other vendors and professional people that support us. So people plays an awfully big part in the property investment journey. But equally, finance is another big topic. And finance actually breaks down into a series of subtopics. And we've already talked about investing or investment, properties and investment. We've talked about things like criteria and key performance indicators. A big area which we haven't gone into a lot of detail in, I must admit, but it's a whole issue of lending and financing in that sense. And today is all about, really keeping a good record, and it's kind of keeping us safe, knowing where we stand and that type of thing. And I'm going to do my best to illustrate in a simplified manner the sort of good principles of good record keeping and accounting systems and things to be careful of and a few pointers in that respect. So that's what you can look forward to, and I do promise you I'm going to try and make it less than dull, if I can put it that way. But in the meantime, I'd just like to hand over to Kaza, who's going to give you a bit of an outline as to what to expect over the course of this particular episode.
Hi Richard, I am doing great this week, thanks. So, a little later, I will be back with your voice, and let's just say that we now have an international audience. Find out more in a while. We have another great resource to aid your learning and education, and not just in property, with today's Shoutout. But before all that, we have our main topic, with Property Chatter, and Richard, I do believe you are planning on making this topic of financial systems and accounting a fun one today. We shall see. Back to you now, Richard.
Okay, so let's get on with this week's featured topic with Property Chatter.
So, thank you very much, Kaza. Yes, it is going to be fun. So, yeah, as I mentioned, we're looking at finance in property, and specifically when it comes to record keeping and that type of thing, property financials. So, it isn't the lending side of it, it isn't the investment side, it isn't KPIs and that sort of thing, although that can form part of this particular area. It is all about keeping good records and understanding the difference between different ways of recording things. So I've got what I call the 1, 2, 3 system of accounting to share with you as a sort of a image that you can take away and have in your own mind. Hopefully this will help. I have to really give some credit here. This is a form of a shout out to a teacher that I had at college. Now, At school, I was a pretty average student. Maybe shouldn't say that, but I was a pretty average student. I was perhaps slightly above average with English, but pretty well got average grades at what was then O-levels, is now GCSEs, so that dates me as well. But needless to say, I went to college and I studied business and accounting at a college, and I was introduced to a teacher called Sue Waldridge, and Sue I credit to really explaining accounting in the most simplified way I could grasp, and has stood with me for many years. I subsequently went on, in fact, to train as an accountant with a large practice called KPMG, so obviously has some sort of lasting effect on me. Went through university and indeed started training as an accountant. I didn't stick with the profession because I think there was too much in terms of number crunching, or auditing is not, an exciting profession in my opinion. Sorry for any auditors and accountants out there, that's just my personal view. I'm very much more a people person. So I migrated actually not too far, but into financial services. So in financial services, I was able to work with businesses, looking at numbers and dealing with numbers, but also dealing with people. So that's a little bit of a digression perhaps, but I just wanted to share the context there and give a little bit of credit to Sue Waldridge, as I mentioned. So this 1, 2, 3 system, I was trying to rack my brain as to an easy way to kind of explain an accounting system which wouldn't completely lose the audience, and obviously would be some way in which I could articulate this in an audio format. So this is what I come up with, the 1, 2, 3 system, which literally hit me when I was showering this morning. I thought, that's it, that's what I need to do. So the 1, 2, 3 system is this: for any one thing that you have going on in your property business, imagine that you have 2 pebbles and then 3 buckets. So that's the 1, 2, 3. One thing, 2 pebbles, 3 buckets. So just have this image in front of you that you're sat there, there's one thing, you've got 2 pebbles, and anytime something happens, you need to decide which 2 out of those 3 buckets the item's going to go into. So I'll probably better illustrate that now so you can understand and follow where I'm going. But let's take an obvious thing like rent. So with property investing, unless you're trading property, you're usually going to be involved with rent collection in some way. So the one thing is rent, just to make that clear. So, but we need to break that down into 2 pebbles, don't we? Yes, we do. So the 2 pebbles in this particular scenario, they represent 2 sides of the same coin. They're 2 things. In accounting terms, it's actually called double entry bookkeeping. But 2 pebbles makes it nice and easy to understand. And then the 3 buckets I've mentioned are where we allocate those pebbles. And the 3 buckets in simple terms are: bucket number 1 is the profit and loss account, sometimes known as the income and expenditure statement. So that's the incomings and outgoings to run the property business. The second bucket is the balance sheet. Now the balance sheet keeps records of assets and liabilities, fundamentally. And then the third bucket is the cash flow statement. The cash flow statement records every incoming cash and every outgoing cash. Now cash, obviously I don't mean cash in hand, or anything dodgy. I mean literally, bank transactions, anything that you need to pay for or you receive money for is called cash flow. And in fact, just whilst we talk about that, I would make a clear distinction with a property business. It is a business and it's separate to ourselves. So that actually means recording everything relating to the business, even if everything is in our personal name. And the best way of ensuring that things are kept in order is to have a separate bank account for all business expenses. So everything to do with the property, in other words. So I, for example, have at least 2 bank accounts, but I have a personal bank account for everything to do with my day-to-day living, but I also have a business bank account which I operate for my property business. So all my rent and all my expenses that relate to my property business I keep separate from my personal finances. And if you take nothing else away from this particular episode, then that is one: just have a separate bank account. Trust me, trying to unpick what is personal from what is business at a later stage, when the memory's gone a bit foggy, is very tricky. So that's the first piece of significant advice. But just to go back to my 1, 2, 3, the one thing, the 2 pebbles is 2 sides of that same transaction, and the 3 buckets are the profit and loss account, the balance sheet, and the cash flow statement. So that was a little bit of the theory. So let's just put it into practice, and let's just take that example of rent that I mentioned. So the 2 pebbles for the one thing of rent would be income. So rent constitutes an income to us. So 1 pebble needs to be thrown into the profit and loss account or income and expenditure account bucket. That's 1 pebble gone. Then we have another pebble. And the other pebble, under normal circumstances, would be thrown into the cash flow bucket, because we would have received money from the tenant to pay for the rent. So you can see then how rent breaks down into 2 things. It is both an income and a cash receipt. So that's just a simple way of explaining that. Now, a lot of you might be thinking, well, don't always get paid the rent, and that's true. So let's just think about that scenario. So we have a tenant in the property, and there is a rent, obviously, but the rent is not physically paid. Now, there's still 2 pebbles here. 1 pebble is still called rent. We throw it into the profit and loss bucket. But instead of throwing the second pebble into the cash flow bucket, because the tenant's paid, obviously in this case, they haven't paid. So it becomes a liability. It's actually an asset. Sorry, it's an asset, just to confuse you. We are owed that money from the tenant, and they haven't paid it in cash yet. So we can't throw it into the cash flow bucket because we don't have the cash. So what we end up doing is throwing it into the balance sheet bucket instead, because it becomes an asset. It's money that is owing to us. Now, hopefully, we'll get that money eventually, when the tenant maybe pays us. And that often is the case with rent arrears. They fall behind, but eventually they pay us. And so in that situation, all we end up doing is taking that pebble that we threw into the balance sheet bucket out and put it into the cash flow bucket instead. So when we get paid the rent, we just transfer from one bucket to the next. I hope I didn't overcomplicate it by using the wrong description. And rather than re-record it, I thought it'd be more entertaining to leave it in. So, okay, that's a situation with rent that's paid. A situation that rent's delayed, what we call arrears. There's a third situation with regard to rent, and that's if rent is not paid at all. And so a tenant absconds, or we end up taking them to court, evicting them, and just don't get paid the rent. There's a lot of scenarios where that can unfortunately happen. So here we still have 2 pebbles. But in this case we still throw 1 pebble into the profit and loss bucket for the rent, because we're assuming we should have got that money. It should be accounted for, that rent. But the other pebble, so rather than calling it an asset now, which we hope we're going to get paid at some point in the future, which is what happened with the rent arrears example. In this case, we're pretty certain, or we make a judgment after a period of time, that we're not going to get that money. We're just simply not going to get it. And that's what's called a bad debt written off. And so we actually take it away. And so we actually throw that also into the profit and loss bucket. But with the rent, it's gone in the income side, and with the bad debt written off, it's gone in the expenditure side. So it's a way of deducting our rent. So slightly more complicated, a bit unusual perhaps, but we're still using our 2 pebbles, and instead of it going into separate buckets, it's actually gone into the same bucket in that illustration. So that's just my 1, 2, 3 system, taking one thing, 2 pebbles, 3 buckets. Let's just look at it in a slightly different way. Let's look at it with a mortgage, buy-to-let mortgage. So the one thing is the mortgage. The 2 pebbles, on the other hand, well, when we take out the mortgage, we actually get cash because the lender gives us money. So 1 pebble obviously goes into the cash flow bucket because we get money in to the business. The second pebble, however, gets thrown into the balance sheet bucket because in addition to getting the cash, of course, we owe that bank the money, and that's what's called a liability. So the liability sits on our balance sheet. So that's where the one thing, the mortgage, falls into 2 pebbles, the cash that we get in and the liability that we go out. And obviously we've allocated it across 2 of those 3 buckets, the cash flow and the balance sheet. So that's my 1, 2, 3 system illustrated with a couple of different things. And all you do actually with with a property business is that for any one thing that you have, and it could be a bill, it could be maintenance costs, it could be professional fees, anything at all, just think in terms of the one thing, breaking it into 2 pebbles and then 3 buckets, and hopefully I've given enough information there to use that and simplify the way things work, because it can get confusing, and as you can see that it makes a difference as I go into descriptions. It makes a difference where things are reported for different people under different circumstances as well. There we go. So to take this logic a little bit further, we're going to get into now a little bit more depth. And with a business, if you were running a formal business, anybody who has would be familiar with the financial statements, the accounting statements. And I'm going to use some of those headlines to help illustrate property as a business, in fact. So with the financial statements, we basically get 3 main statements. We have a balance sheet, as I've been mentioning. The balance sheet shows assets and liabilities. We have a profit and loss account, which sets out the revenue or income and the expenses of the business. Sometimes a profit and loss account is called an income and expenses statement, but it's the same principle. And we also have a cash flow statement, and the cash flow statement shows all money coming in and all money going out. And the cash flow could relate to things in the balance sheet or the profit and loss account. So as I mentioned, it's kind of like a bank account. And so that's illustration there. But equally, if you've ever looked at a set of accounts, if you own shares and you get accounts issued for the AGM, or you run your own business, or you've just looked at accounts for whatever reason, you'll notice there's what's called notes to the accounts. So you've got those 3 statements, then you have notes to the accounts. Now, the most significant thing that I'm going to talk about, at least in terms of the notes to the accounts, are contingencies. So they're things that don't yet get reported in the financial statements, but they could happen. So in property terms, a very good example of that is if you have, say, an early redemption charge on a mortgage. So you take out a fixed rate mortgage. Let's say it's I use an illustration of a 5-year fixed rate mortgage. The lender will say if you end that mortgage within that 5-year period, you'll have to pay them not only the money that's outstanding on the balance, but an early redemption charge. Now, it's called a contingency because if you don't actually redeem that mortgage early, then you never pay that charge. So if you wait for 5 years and a day and then settle that mortgage, there will be no early redemption or early repayment charge. But however, if you redeem that mortgage after 4 years and 11 months, which might be a bit unfortunate timing, but just to illustrate my point, then that early redemption charge or penalty would apply. But on day 1, when you take out the loan, it's what's called a contingency. It might happen. So if we were looking at a real business accounts, we might show early redemption charges in the contingency section of the accounts, and I'm just going to illustrate that as we go. In fact, I probably have. The main one is those early redemption charges. But the other thing that's kind of implicit here is not necessarily what's in the accounts, it's how we record the accounts. So that's what's called as accounting systems. So they're not part of the accounts themselves, but we need an effective system to be able to record what's going on and to work out what goes into what of those buckets. So as I move through this, I realized that I'm actually probably most proud of this chapter in my book, The Property Investor Toolkit, because I was able to outline and illustrate and show figures and that sort of thing to explain. So I am going to direct you to the book, because it does set that out. So I'm just going to give some headlines in the podcast, which will help explain things. But for a fuller explanation, I would actually divert you to the book. But starting with the balance sheet, as I mentioned. A balance sheet, as I said, sets out the assets and the liabilities of the business. Now, an asset is something we own of value, and that's my definition. And the biggest thing that we're likely to own of value with a property business, of course, is a property itself. There could be other things like furniture and white goods like fridges and cookers and this sort of thing, but the most significant thing that we would own of value is the property itself. So that would be an example of an asset. And similarly, the definition of a liability is something that we owe of value. So again, the biggest thing probably that we're likely to owe as a property investor is a mortgage. If we're using financing, a buy-to-let mortgage is probably going to be our most significant liability. Now, there could be other liabilities. So, for example, if we the easiest one to explain is if we get, say, an electric bill. If we're picking up the electricity charge of a property, if we were to receive an electric bill, at the point in time we receive the bill, it's a liability. We won't have paid it necessarily. We may pay it later on. So at the point we get the bill, if we haven't already paid it, that would be a liability. But for all intents and purposes, the mortgage is going to be our most significant liability. Now, the balance sheet, in very simple terms, adds up assets and it adds up liabilities, and it therefore can tell us our net asset position. So the net asset position is either positive or negative, depending on whether assets are higher than liabilities. Now, obviously, we're looking for it to be positive, where our assets exceed our liabilities. So our net asset position is taking away the, in most property investors' terms, the total value of our property, and deducting from that the total value of our mortgages. There'll be other bits and pieces, but essentially that's what produces our net asset position. It can get a little bit complex because in addition, in the balance sheet, we also show our profit and we also show our bank balance, but I don't want to get into too much complexity on a podcast episode, and that's why I've directed you to other resources perhaps to find out the information. But another point that's worth really highlighting when it comes to the balance sheet side of things is this whole idea of capital expenditure, or is sometimes known as CapEx, and operating expenditure, also known as OpEx. And these two things are different, and really what it means is, and it's most relevant for us as far as the taxman is concerned. The taxman will essentially allow us to make deductions against certain gains that we make in property. So if it's rental income, we're allowed to offset what's called OpEx against rental income to reduce our tax liability. But we're not allowed to offset what's called CapEx against that same rental income. We are allowed to offset it eventually against tax, but it's only on any capital gain we would make on the property. And the capital gain would only come if we sold the property under normal circumstances. I'm talking about standard buy-to-let here rather than property trading, to distinguish, because it kind of does get a bit more complicated when you talk about trading. But let's leave that for the detailed analysis, but for the simple explanation, that's that. So CapEx and OpEx. Some of the illustrations that the HMRC, the taxman, would use to differentiate, he would say things like buying and selling fees related to the property itself. So things like legal fees would traditionally be classed as a CapEx expenditure, capital expenditure, and therefore we can't offset those against our rental profits. Similarly, structural works, white goods, and some higher, upgraded type of replacements that go in the property. So a high spec kitchen replacement rather than a standard replacement would be an illustration. It can get a bit grey, but they're some of the illustrations. How is that relevant? Well, it's relevant because as a property investor, the more money we can defer from a tax point of view, the better. The more money we retain in the short term, and therefore the more money we've got to invest in additional properties. So CapEx is not tax efficient because it means we have to wait until we sell that property before we can offset that money against tax. So therefore OpEx is the most efficient expense that we can have, because it reduces our tax burden on our rental profits. And you can in fact have a situation where you buy a property and you don't even pay tax for maybe a year or two, because you've had to do some OpEx expenditure, operating expenditure on the property. Illustrations of operating expenditure would be normal repairs and maintenance, like-for-like replacements. Equally, cost of financing is an OpEx, operating expense. So all of these costs can get deducted from rental profits. And of course, if you've not let the property out for a period of time, you've not made the rental income, it's quite common, in fact, when you acquire a property that you don't have any declared rental profit for at least the first tax year, possibly longer. So understanding this distinction between CapEx and OpEx is also a very important thing. There's more I could say on this topic. I just have to refer you to the book, to be honest, because I'm just not going to do it justice in an audio format. So moving on to the next statement, we've got what's called our profit and loss account, or the P&L, sometimes the income and expenditure statement. So in the P&L, we record all of the revenue or income relating to our property business and all of the associated expenditure, or OPEX, as I've been mentioning under the above description. So it collects everything together in effect. Now the revenue is pretty straightforward. With a buy-to-let, it will be rental income primarily. There could be other things, but let's keep it simple. It will be rental income. If it was a trading business, i.e. buying and selling property with not renting it out, the income would actually be the proceeds from sale of the business. So that's a distinction that we could make if we're actually a trader versus a long-term investor. But probably the more complex side of this discussion comes when we're looking at expenditure, an allowable expenditure, as I alluded to under the distinction between CapEx and OPEX under the balance sheet section. So let me just give you some examples of what are operating expenses and are allowed to be offset against rental income, and therefore would be shown in the profit and loss account. So mortgage interest is an example. Not the full mortgage payment if you have what's called a capital repayment mortgage, because that falls into two sections. There'll be interest and capital repayment. It's only the interest element which is allowed to be offset against the rental profits, and therefore would be an expenditure in the P&L. Other things typically would be letting agent fees and expenses, repairs and maintenance, and that type of thing. But there's also some more indirect expenses, and some things are actually allowable as an offset against profits, and it's worth looking into and having a chat with an accountant on this, because things like travel and mileage to visit properties, to do inspections and this sort of thing, professional fees such as an accountant is an allowable expense. Some training costs are. Now it's a bit complicated what is and what isn't, so bottom line is if it's to develop an existing skill, it is allowable, but if it's to develop a new skill, then it isn't. So it's a bit complicated as to what is allowable. And then you've got some standard stuff like print, postage and stationery and telephone, which is also allowable. So don't forget to record those kind of costs. And very simply, similarly with the balance sheet, we've got a situation where we add up both columns, if you like, income and expenditure, and we end up with a net position. That net position is a net profit or a net loss. And so very simply, if our income or revenue is higher than our expenditure, then we'll end up with a net profit, and obviously the opposite would be true. So the third statement is the cash flow statement. Now you might have heard the saying, I quite like quoting this saying, that revenue is vanity, profit is sanity, but cash flow is reality. And you might have heard another statement similarly, which is cash flow is king. And I think I said there was one thing, if you took away from this episode, that'd be the most important thing. Probably this is the most important thing, that cash flow is king. A bit of a morbid example I used in the book and I use now is that lack of oxygen to the brain is ultimately the thing that kills any human being, unfortunately. But in a business, lack of cash is what will kill a business ultimately. So we can usually survive difficult trading periods if we've got enough cash. So just to emphasize the whole value of cash. But in terms of the cash flow statement, as I was mentioning earlier, it records, it's the business bank account. It records everything that goes in and out of the business. Cash inflows, cash outflows. And of course, some of those inflows and outflows could be in the profit and loss bucket. Some of them could be in the balance sheet bucket, but they're all going to be landing eventually into the cash flow bucket, to use my 3 bucket analogies. So this is really important, and so many people forget that the timing of cash flow is so relevant. So where the most significant or most sensitive part actually with cash flow is when we buy a property. All of the costs are pretty well front-ended. The purchase costs, the associated refurbishment, this sort of thing. We're probably not going to rent it out for a period of time. So our cash burden is going to be most significant at the beginning of owning a property. And then there's other times in the cycle where that can be repeated. So for example, if we do a refurbishment after a couple of years, we're going to be cash flow constrained. So having a grip on cash flow, understanding the timings and the principles of cash flow is very, very important. But there is a cash flow statement and it's important to recognize that. But keep a separate bank account, understand the timings of things, and have Actually, I was just going to give the clue away. The next section is contingencies. So in the introduction, I did talk about contingencies such as early repayment charges, something that might happen, but it isn't assured that it will happen, is what's called a contingency. So always keep in mind these contingencies. The what if. Is the question, what if something were to happen? So what if I was to settle my mortgage earlier? Are there extra costs? Is a question to ask there. But other things to perhaps consider in terms of the what if question are what about maintenance? And so many people enter into a property investment deal and don't consider voids and maintenance. They have to be considered, and they will happen. You'd be very lucky, certainly, to survive for any length of time without any voids or any maintenance charges. So a lot of people ignore that, but that's something to consider. Equally, what if the tenant doesn't pay? We need to make a provision for that type of thing. What if interest rates rise or fall? That will affect our mortgage payments. Even if we're on a fixed rate mortgage, ultimately that might change. So there's a number of contingencies that we need to make provision for. Another contingency actually is kind of insurance based, and so fire is a contingency. It could happen to the property, so it makes sense to take adequate risk protection, and adequate risk protection would be insurance. So that's the whole notion of contingency, but it could be such a wide topic. I don't really want to go into a lot of detail on podcast episode. Then the final section that I kind of wanted to cover is that of accounting systems. And in fact, if I refer back to my interview a couple of episodes ago with Damien Fogg, when I asked him, what are your suggested systems, he said Outlook and Excel. And to be honest, from an accounting system point of view, Excel is perfectly adequate. So think about those three buckets that I mentioned of the profit and loss, the balance sheet, and the cash flow statement, and think of three spreadsheet tabs, which are those three things, and that's an accounting system. And all you really actually need to do is have income and expenditure recorded in your profit and loss bucket or tab, and then you have to have your assets and liabilities columns recorded in your balance sheet tab or bucket, and similarly with cash flow, everything in and out in the cash flow bucket. So that's probably all you need, certainly as a fairly junior investor. And as Damien suggested, he suggests Excel's perfectly adequate for a couple of hundred properties. So there are more sophisticated systems that can be used, and if you do use your accountant, they may give you their own spreadsheet. For example, there are a number that you can get hold of from various sources, but very simply, all you need to do is think of my pebbles, think of my buckets, and then construct a spreadsheet, or even just a paper journal. Although I wouldn't recommend that on a practical basis because it's hard to keep tabs with, but they're the essentials in that respect. So I really have kind of run through that quite quickly. I'm not sure if it's come over very well in a podcast episode. I've got a lot more illustration in terms of numbers and that type of thing that is in the book, so I'm going to refer you to that for further insights if you like. But I kind of wanted to highlight this point that finance is such a big part of being a property investor, but finance is a big topic because, as I mentioned, it covers investing. So the principles of investment is a financial consideration. It also covers things like raising money, like mortgages. So I'm going to probably have a whole series on financing, believe it or not, coming up. So I'm going to address that in much more depth later in a later series. Similarly, the record keeping is essential as well, but we touched in an earlier episode about key performance indicators and criteria, which is another form of number crunching or finance. But today, of course, it's all about the accounting systems and the 1, 2, 3 system. One thing turns into 2 pebbles and 3 buckets. So have that image in your mind whenever you're thinking about anything to do with property investing, and you probably won't go too far wrong.
Up next is Your Voice. It's all about you and your property world.
I am not so sure about fun, Richard, but it did look like you at least tried to bring some imagery into the subject earlier with your pebbles and buckets illustration. So, that made things simpler for an audio format. Well done for that. But maybe best to leave the fun stuff to me, hey? Now, talking of fun, You don't get much more fun than a carnival in Rio, do you? Well, we recently learned that, whilst the podcast is available worldwide via iTunes, that if you happen to subscribe outside the UK and then leave a review, then we do not always get to see it. We discovered this when a listener in Brazil contacted us, and then we saw a couple of reviews left for the show over there. Listening to a property investing show aimed primarily at the UK deserves a mention, don't you think? Here are a couple of reviews from our fun, yet ever so smart, property investing friends from Brazil. First to Robson Bass, who gives the show a 5-star rating and title very good. Very easy understanding of property investing issues. I recommend. Thank you, Robson, or as I understand you say in Brazil, Hobson, for that review from afar. Then, we also spotted another Brazilian 5-star review, this time from Anna. She describes the show as simple and direct. Very good podcast. Simple and easy to understand with very useful tips. Thank you so very much for listening and for leaving such nice reviews, Hobson and Anna. I wonder where else we have listeners that we don't know about. In addition to sharing reviews from far and wide, we would love to hear more of your stories, so here is a challenge for you. Send us your funniest, true property stories and we will select 1 or 2 to share on a future show. The contributor will get a copy of the paperback version of Richard's book, Property Investor Toolkit. Email us at podcast@thepropertyvoice.net for your chance to win and make us laugh too. That's all from me. Now back to you, Richard, for the shout out.
And now, where you can go for more great resources with the shout out.
Okay, so today's shout out is, in addition to shout out back to my old college lecturer or teacher, Sue Waldridge. I'm not sure she's going to get the credit she deserves, but I thought I should do that. But the main shout out for today is actually a resource called Scoop It. Well, it's actually scoop.it, and Scoop It is a platform effectively which consolidates insights and curate. It's a curated content section is what I'm trying to say for topics. So it covers a wide range of different topics from activism to well-being. And obviously one of those topics is what they call real estate. It's aimed at the international community, so it's not exclusively a UK resource. So it doesn't say property, it says real estate. So, but the Property Voice has a section on Scoop It, so you can find us there. Just look for the Property Voice, and what we use that platform for is a means of staying up to date with news and information that circulates in the area of property. And you can do keyword searches so that you're actually being fed with stories which are relevant to your area of interest. Obviously, I'm interested in property, but if I was interested in well-being, for example, or any one of the other sections, I can create a page, I can have feed information being fed there, and it's a nice little funnel to profile and see what's going on in the world. Of course, that information can be shared on various social media and whatnot. In our particular case, we have a following. By all means, come and follow us on the site. That'd be great to have you. But we also have the stories that get recorded onto our main website every week as well. But it's a great resource, is really the point. So Scoop It is the shout out for this week. So as another interesting week on the Property Voice podcast. I hoped you liked my 1, 2, 3 system with my 1 thing, 2 pebbles and 3 buckets. I hope that came over quite well in an audio format. There are other places obviously to go and find out that kind of information, but as I say, I hope it gave you some insights into keeping effective accounting and financial records with our property business. So that was it for another week. By all means, do head over to our website where the show notes will be listed, and all the resources that we've mentioned in today's show will be listed as well. get involved. I mean, maybe you've got some great places to go for resources in terms of accounting and record keeping. A lot of people are always asking about spreadsheets, and I'd be interested to find out great resources in that respect. So if I could ask for one thing this week, it would be perhaps to go to the show notes and just provide some links to some great resources. That would be fantastic if you could do that. But in the meantime, I just want to say thank you so much for listening to another episode of the Property Voice podcast. And until next time, it's ciao ciao.
Ciao ciao.
Thank you for listening today. Now head over to thepropertyvoice.net for more inspirational content and get updates through our mailing list. Join us next time on the Property Voice podcast. And if you enjoyed the show, please don't forget to rate us on iTunes.